For more on this is Paul Mortimer-Lee, Global Head of Market Economics at BNP Paribas. Paul, thank you so much for coming
Pleasure.
in. Everyone is looking at this Portuguese bond auction, but actually, even if it does go well, does it mean that Portugal doesn't need a bailout?
No, it doesn't. I mean, they live to fight another day. That's what it means. But I think there are many people in the market, and I'd go along with that, thinking that eventually Portugal will go to the bailout. And clearly the government's resisting that because it would politically be very difficult for the government to go cap in hand to the IMF and have some unpopular policies imposed on it.
Like we've seen in Greece and like we've seen in
Greece,
Ireland.
yeah. I mean, the fact is that probably it's in Portugal's longer-term interests to have a programme to undertake some much more radical structural reform. But you have to go to the edge of the cliff. You have to go to the crisis to get the political will to force the politicians to do that. So this cycle of continued crisis, continued interest ahead of bond auctions is going to continue until eventually, maybe by April, maybe by June, they'll go to the EFSF.
Now, the bond auction is in exactly 2 hours and 15 minutes from now. What happens if it's not a success and it's actually a flop? Will it actually force them to trigger that mechanism a lot sooner?
Well, I think if it's actually a flop, then it says that they can't fund themselves. You know, that Portugal keeps making the point that it doesn't have as big a deficit as Greece. It doesn't have the same debt-GDP ratio. That's irrelevant. What matters is, can you fund yourself? Can you raise the cash? And for Portugal, it's very difficult because they have a huge current account deficit, which means there's not enough domestic savings to finance the government deficit. So they've got to attract cash from abroad, and clearly in this environment it's very difficult to get foreigners to put cash in an economy that's going to shrink again this year and that has, over the longer term, had very poor growth. And so eventually they're going to fail. It's a question of when.
A lot of the authorities, of course, have been discussing what happens to the mechanism after 2013, about restructuring. Are we going to see restructuring as absolutely inevitable, and are investors going to have to take a haircut?
Well, I mean, clearly the markets for Greece are pricing in at some stage a restructuring. And so that is, I think, the market sees an increasing possibility. Depends when it's done, how it's done. I think if it were to happen for, say, Greece, what you'd see is debt would be extended to be much longer maturity and lower coupon. I don't think there'd be any reduction in principal. And the market's already pricing that in. That we have to go forward. I mean, clearly this piecemeal process where Greece goes and then Ireland goes and then Portugal, you know, the question after Portugal is who's next that the market will ask.
Yeah.
And the problem is that Europe has a very piecemeal process for dealing with this. We need something that's much more holistic, much more systemic, and deals with it once and for all.
Paul, thank you so much. Not the first analyst and economist that says, yes, we just need something much more radical. Paul Mortimer-Lee there.